Joining me right now is BlackRock Fixed Income Chief Investment Officer Rick Rieder with $2 trillion in assets under management that you oversee at BlackRock of $5.98 trillion. A lot of money there, Rick. Good to see you.
Good to see you.
Thank you so much for joining us. So let's talk about this inversion that we saw this week where short-term rates were higher than longer-term rates. How important was that? And we focus on it because a lot of people think that when you see that kind of inversion, that indicates a recession is on the horizon.
Yeah, and by the way, it's what hit markets at the beginning of the week. Listen, I would say one thing. I mean, what happened this week around people calling for the Fed's got to cut rates 100 basis points, the curve's inverting, it means we're going to recession. It's just grossly overdone. We're not going into recession. In fact, this year, we think we can run 2-ish% GDP growth. Still pretty good. Potential in this country is about 2%, but it's gotten a bit overstated. The inversion of the curve is important. In fact, it's the best indicator of when the economy is going to slow, but there's some technicals. The Treasury's been issuing an awful lot of front-end product, a lot of 2-year notes, 3-year notes, Treasury bills. And there's been a tremendous pension fund bid for long-end interest rates. Some of this inversion is technical, so you need to discount a little bit. But the thing you got to watch, if it does invert more significantly because of global growth continuing to slow, that's something the Fed's got to keep their eye on. But the recession talk that drove rates to extraordinary levels earlier this week is just overdone.
All right, so it's overdone, but why is it that so many past recessions were, they came after the yield curve actually indicated that maybe it is on the horizon? I mean, hasn't this been an indicator in the past and it actually did come true?
It's actually the best indicator,
yeah.
Full stop. However, it also predicts a lot of non-recessions. And like I said, there's a technical condition at play that's driven some of it. The second is there is a reasoned tone. I mean, we talked about on your show for a couple of years now. The Fed was raising interest rates. The Fed was on this mode of autopilot, raised rates 10 times. Pretty significant dynamic in terms of how much risk do you want to take in long-term interest rates. Today, the Fed's not going to raise rates this year. And if you think about there's an asymmetric dynamic, is if the economy slows, the Fed could cut. So that's what the markets are starting to price in. So, listen, I think we have to keep an eye on it, but not nearly suggest that, gosh, this is the indicator we're going to a recession.
So what do you think is going to happen this year? I mean, I agree with you. You've got a GDP story that is still showing growth. You've got a much better situation in the United States than where you're looking at in Europe and in Asia. But Steve Moore, the nomination of President Trump to go on the Fed board, Steve Moore said to the New York Times earlier this week, the Fed should cut rates immediately. So what do you think the Fed will do? Do you think maybe the Fed cuts that rates this year, or will it be a 2020 affair?
So I don't think the Fed needs to cut rates at all. In fact, our economy is operating at a good level. I just think the Fed should go away. And just for the next year, we're pretty close to equilibrium, and you've got an economy that's operating well. We've got employment data that is incredible. The economy is going to keep putting people to work. We should keep doing that. There's no reason to cut that off. It's part of why we were aggressive about stop raising rates last year.
Yeah.
We're at equilibrium. Economy's producing a lot of jobs. There's a reason why we're going to continue to produce a lot of jobs. A, it's a pretty good economy. B, we're moving to a service economy. We've talked about it on your show for years. When you move to a service economy, education, healthcare, they're very labor intensive. We don't have enough people actually in the country. If you look at jobs openings today, the job openings are at historic highs. Jobs hard to get to historic lows. We're putting more people to work. It's great.
Yeah.
Fed should just move to the background, let the economy do what it's going to do. I don't think we need a cut today. The interesting, like you said, if you watch the housing data in the next quarter, there's a lot of weather impact this quarter, and mortgage rates have come down a full %.
Yeah.
That is going to start, you're going to start to see housing pick up again. It's pretty powerful.
We are seeing some green shoots in housing right now, aren't we?
Totally.
Yeah.
And you're going to, people misinterpret. The housing market is extraordinarily interest rate sensitive. By the way, part of why it was so soggy, you keep lifting rates, you look at home builder stocks, you keep lifting rates, you press the mortgage rate higher, it's going to break the housing market. It's what you started to see in the fall. It's part of why the interest sensitive parts of the economy were slowing. The Fed didn't need to keep hiking into it. But when you drop the mortgage rate 100 basis points, watch housing starts, watch building permits over the next couple of months. By the way, if you strip out California because of the wildfires, you see a very different dynamic in housing. Permits are picking up, but housing starts in California have been low for obvious reasons post the wildfire. California's 15% of GDP in this country.
Oh, wow.
You strip California out, the rest of the economy, the rest of the housing market's actually pretty good. But watch the next month or two, watch permits, watch housing starts, and my sense is they're going to be significantly better.
I love this news. By the way, you have been so spot on this, Rick. At the end of last year, I'm talking September, October, you came on this show and you said to me, the Fed needs to stop. And everybody was talking about raising interest rates. You were among the first, if not the first, to say that. So thank you for educating our viewers the way you did. Is this time different because we've got the whole balance sheet situation as well? The Fed is winding down that balance sheet, wanting to take it to what, $1.5 trillion by year end?
Yeah, I don't think the Fed needs to, we've talked about for a while. People say the balance sheet's too big, the balance sheet, they need to cut the balance sheet. It's wrong. People don't take the numbers into the equation in terms of what the size of the balance sheet is. Our balance sheet in this country is about a little over 19% of GDP. It's over 40 in Europe. It's over 100 in Japan. Fed can run a bigger balance sheet. I think people underestimate when this Fed said we're going to stop cutting the balance sheet. All of a sudden, the liquidity dynamic that was really difficult in the system last year. Fed was draining liquidity, reducing balance sheet, while the Treasury was issuing a tremendous amount of debt, draining liquidity. All of a sudden, the Fed's changing that. The liquidity will improve. The stability of the markets will improve. The financial system will improve. And there's no risk around a balance sheet that's 19% of GDP on the way to under 19. I think one of the big things is they're going to reduce their balance sheet to more short-end treasuries. Since the Treasury is issuing short-end treasuries, it's the right thing to do. And by the way, it'll steepen the yield curve a bit, which is also pretty good.